Okay, let's unpack this then. Today's deep dive, it's all about understanding a specific type of company share, these preferential shares.
That's right. And we've got, well, one main source guiding us here, a document that really lays out their key features.
So our goal here is really to, you know, cut through the jargon a bit, explain what these things actually are, and maybe figure out why they might be relevant to you.
Especially if you're looking at investing maybe on the Colombo Stock Exchange or really anywhere these pop up.
Exactly. Let's get into what makes these shares, well, different.
Well, the name itself is a big clue, isn't it? Preference shares. It kind of signals priority right away.
Right. Yeah, the source jumps right on that. Says they're special company shares that get priority over regular shares for dividends. So, first in line for payouts.
Pretty much. If the company turns a profit and decides, okay, let's pay a dividend, these preferential shareholders get theirs before the common shareholders see anything.
Okay. So that gives a different feel, maybe a bit more reliability on the income side, assuming the company actually makes money, of course.
Exactly, if they're profitable enough to pay out. That's the key caveat.
Now, the source gets specific on structure. It mentions a face value of rupees 10. What exactly is that base value?
So that's essentially the price the share was originally sold at by the company. In a market like Colombo, that 10 rupees is sort of the starting point, the value it was created with. It's a reference.
Got it. A reference point.
Rep.
And the dividend tied to that, it's listed as rupees 0.70 per year. Sounds pretty straightforward, like a fixed income.
It is a fixed amount, yeah. 70 cents per share per year. But, and this is a really crucial detail the source points out, it's non-cumulative.
Ah, okay. Non-cumulative. So if, let's say, the company has a bad year or just decides not to pay that 70 cents, you just don't get it for that year. It doesn't, like, roll over.
That's precisely it. You miss out for that year. The company doesn't owe it to you later. It doesn't accumulate, which is, quite different from some other types of preference shares out there. So it's prioritized, yes, but not absolutely guaranteed every single year, only when it's paid.
Okay, that's a very important distinction. Fixed amount when paid, but not a debt if skipped. Right. Now, here's where it seems to get potentially more interesting for the shareholder, the convertible feature.
Yeah, this adds a layer of flexibility. The source says that after holding them for 5 years, the shareholder gets an option.
An option.
An option to convert their preferential shares into the company's regular, ordinary shares.
So you could swap them. Trade in the preference share for a common one. The source hints this could be profitable if those regular shares have, gone up in value.
Exactly. That's the potential upside. See, your preference share, its value is fairly stable, tied to that fixed dividend. But regular shares, their price on the market, like the CSC, can swing quite a bit up or down.
Hmm.
So if the company's done well over those 5 years and its regular share price has climbed significantly, converting lets you tap into that growth potential.
You'd be giving up the dividend priority, though.
You would. That's the trade-off. Swap the dividend priority for potential capital appreciation with the common stock.
Interesting. And one last feature mentioned, irredeemable. What does that imply from the company's perspective?
It basically means the company can't force you to sell the shares back to them. They can't just say, okay, here's your 10 rupees face value back. We're taking the shares.
So they can't just, call them back in.
Nope. You, the shareholder, hold on to them indefinitely unless you choose to sell them on the market or, of course, use that conversion option after 5 years. It provides a kind of permanence for the investor.
Okay, so let's try and summarize this from an investor's angle. The source seems to highlight things like relatively low risk because of that dividend priority in good times.
Mm-hmm. When paid.
Right, when paid. Then there's the future flexibility with that conversion option down the line.
Yep, after year 5.
And no expiry because they're irredeemable by the company. The example given is simple. 100 shares cost 1,000 rupees, potentially yield 70 rupees a year.
So pulling it all together, these preference shares, based on our source, they offer this kind of mix, don't they? You get the dividend priority if profits allow. You have a fixed base value and dividend rate. They stick around because the company can't redeem them. And critically, there's that strategic choice after 5 years to possibly convert and chase market gains.
Yeah, and that decision point after 5 years, that's really the fascinating part here, isn't it? It brings up a really practical question for anyone holding these. Based on everything we've just discussed, that fixed dividend you might have been receiving, the fact they can't be taken back, but also the potential for the regular shares to have grown. What things would you actually look at? What specific information in that 5th year would help you decide whether converting is the smart play for your situation? What factors swing that decision?
That's definitely something to chew on, especially when you're evaluating these kinds of options, whether it's on the Colombo Stock Exchange or any market where preference shares like these exist.